Can you just drop a 1 in the chat if you can hear me? We're going to be talking today about the US consumer. We're going to be looking at a couple of articles. I'm just checking you can hear me okay before we get into this. And you'll see we've got the on air button here. So we are going to be streaming live as usual. Just want to check everyone can hear me okay. Yeah, that's great. Thank you. That's perfect. And this is going to be probably the last video in this studio as well. I'm going to be breaking down this studio and creating a new studio very shortly. It's another reason I've been streaming from the lounge and other places as well. But today's just going to be a more relaxed video, a more relaxed stream. We're going to be looking at a few articles. So now that everyone has jumped in, okay, that is perfect. Thanks for letting me know. We're going to go straight over to the shared screen here. I just want to bring up some articles that I think will be useful to you so you can just see what's going on at the moment. So I haven't been using CNBC for a while. I thought I'd go on and see what they're talking about today, because the news has been quite an interesting one today. In fact, we'll get into that later. But I saw this one from Jamie Dimon, and he was ripping into the central banks for being 100% dead wrong on economic forecasts. So this came out just a couple of days ago. And he's the CEO of JP Morgan Chase, as you know. Not a big fan of Diamond, to be honest, but he has said some things here which are quite interesting. And he started by saying or warning about the dangers of locking in an outlook about the economy. And this is because, and again, we've talked about this quite a lot, but a lot of these central bankers and economists have been 100% wrong for almost 2 years now. So what has he said then? Prepare for possibilities and probabilities, not calling one course of action, since I've never seen anyone call it. And I think he's talking there about people who say they can tell you exactly where the stock market is going when really they can't. And it says he's the head of the largest US bank by assets, which is correct. He said that he doesn't think it makes any difference. This was an interesting one. Whether the Federal Reserve hikes rates another quarter point at the next meeting. So he's gone on to, let's have a look here. I'll just show you the key points so we're not reading every last line here. But he cautioned about a myriad of factors playing out now, making things even more difficult. And we've talked about this converging of lots of different problems all happening at the same time. And this was even before Russia and Ukraine. And now we've got Palestine and Israel as well to contend with. So this will have some knock-on effects to the global economy. And we're already seeing this. So he said, I want to point out that the central banks 18 months ago were 100% dead wrong. And by the way, remember, these are the top experts in the world that were 100% wrong on a lot of their forecasts. So I think he's quite correct in saying I'd be very cautious right now about what might happen next year. And I think that's probably one of the best things we can all do, is expect the unexpected. While a lot of the economists are expecting things to turn around and everything's going to get better and we're going to see this massive boom, and we'll talk about the GDP that's just come out at the moment, the gross domestic product results, where they are praising the economy and the consumer. Wow, the US economy, wow, it's the best in the world, all this sort of stuff. No, it's not. And we'll break down why that is. Along with the misdiagnosis on prices, Fed officials, according to projections released in March 22, collectively saw their key interest rate rising to just 2.8% by the end of 2023. It's now north of 5.25% and core inflation at 2.81%. He also went on to criticize this omnipotent feeling that central banks and governments can manage through all this stuff. He said, I'm cautious. So if he's using the word cautious, then you know it's a lot worse than that. And the other thing he said is that it doesn't really matter whether we have a 25 basis points move, which is 0.25% interest rate increase, or zero. It doesn't make any difference at all. He also warned of a potential scenario in which the Fed funds rate, so this is your interest rate, could eclipse 7%. When the bank released its earnings report earlier this month, he cautioned that this may be the most dangerous time the world has seen in decades. I had to highlight that line because that is, when you see people like that making these sort of really alarmist, bold statements, for me, I do tend to pay attention to it. And he said whether the whole curve goes up 100 basis points, that's 1% to, in layman's terms, he said, I'll be prepared for it. So he's saying that everyone should be prepared if this were to happen. Now, if you're looking at this from a different perspective, you're not a big investor, but you have a mortgage rate perhaps. In fact, we could look at this in lots of different ways. There's a lot of value in this. Maybe it's your mortgage rate. If you're wondering, is my mortgage rate going to go up? Well, even though a lot of the economists are forecasting the federal funds rate, the interest rate to come down, I wouldn't be so sure that's what's going to happen. In fact, if I were a betting man, which I'm not, I would say that it won't happen. I think it's going to stay at this sort of rate, this elevated rate, for a while yet. And that's if unemployment doesn't drag the economy down, because then we go into employment scarring, which makes it even worse. That's one of the things that was so bad during the Great Depression, 1929 to 1938, because we went into this employment scarring cycle. It was just pulling liquidity out of pretty much everywhere. Some of these markets lost up to 90% of their value, some of them 70%, some of them 80%. Housing market dropped off a cliff as well. People couldn't even pay the rent because they couldn't earn the money, and we're in a deflationary environment. And what are we looking at the moment? We're looking at a stagflationary environment. So there's a lot of things that are going on which are going to make this a lot worse than it currently is. One thing I thought was interesting that he said, Dimon said he supports ESG principles. I definitely don't support ESG. I think that it's been hijacked, and it's been hijacked to make certain people a huge amount of money. And we know that with how they price it as well, and how they sort of put the charts out there. So someone like Tesla has got a terrible ESG score, while you have other people who are very polluting of the environment, and they have an amazing ESG score. So I don't really think the ESG is worth its salt. So this was the next article I saw. Again, this just came out today. The US consumer is walking towards a cliff, strategist warns. I would say the US consumer is sprinting in a 100-meter race towards the end of the cliff. Trouble is brewing for the US economy and its pivotal consumer component. I've got to go into that and explain what that means in a moment. But this was the gentleman that did this interview. He was talking about what he saw, and he was pretty succinct until he got to the forecasts on where the stock market was going. And you could see what was on his mind there. He went from very eloquent to very sort of stop-start. He was trying to be in his head and speak at the same time, because, as we always say, certain people, they will have, they'll be unbiased up until a point where it affects their money. So where did the bias start to come in and affect what he was talking about? It was as soon as they started asking, what do you think is going to happen with the stock market, with equities, etc. Well, he's a hedge fund manager. What's he going to say? Oh, we think there's going to be a massive crash. We think that the markets are going to go down. We think Israel, Gaza, Palestine, etc. This is going to cause issues. Ukraine, Russia, this is going to cause now the bond yields and everything else. No, of course he can't say any of that. He basically has to say, well, it's a little bit choppy, but then I think it's all going to come back booming again. And again, this is why you've got to take it with a pinch of salt whenever you hear people talking about these topics, because they do have some bias around it. But let's have a look at what he said, because I did think it was quite useful. He said a substantial labour market downturn could kickstart a recession. I would agree with that. I would agree with that strongly. He said a slew of recent economic indicators had shown consumers are quickly running out of excess cash, while household savings are coming under pressure. Now, what I found staggering was that they didn't seem to link together, and I thought they would easily spot this, but they didn't. Linking together this massive boom in Q3, which we'll come on to in a moment, and them thinking that the economy was doing great because people were out there spending. No, just look at the personal savings rate. It went down. You look at the debt levels, it went up. This is so simple. This is the sort of stuff that you would learn in junior school or something. It's not difficult. If there's extra money flowing into the economy and it's growing, it has to come from somewhere. If there's a lot of news at the moment about flooding and things like that. If all of a sudden my property started to flood, I wouldn't say, where on earth has all of this water magically just come from? It's magic. It's just, clear skies and there's flooding. No, I mean, of course not. I would say there's water here. Obviously something has caused this. Where has it come from? To me, this is just obvious common sense. I don't know why they never get these connections and start looking into it. Growth. Okay, well, the money's come from somewhere. Let me look where it is. Well, it's debt. It's savings rates plummeting. I don't know. Maybe I'm on my own here, but this is the sort of way I think anyway. He also went on to say retail sales have been quite strong for the last few months, and everyone gets excited about that. But actually, if you look what's going on, he says here, look, household savings ratio has run down. Good, he's picked up on it. And in fact, real income growth has been negative for 3 months. Another good point, he is correct. It has been negative. So it's not all good news. He says, I mean quite the reverse. I think there are some real challenges coming ahead for the US consumer. And yes, I would say yes, there are. But at the same time, remember, the US is an island in that they can do things that other countries can't because they have the fiat currency, the world reserve currency. So they have this advantage that they can do things that other countries can't. At the moment, I do think this will change in the future, but at the moment they can. His comments come even as data suggested the US economy may have turned in another stellar performance heading in the final part of the year. Yeah, that's why I've put it in green, because they're trying to make this out as if everything's come back and everything's great. We're going to go on to this new GDP print in a moment. Many strategists, asset managers and CEOs remain concerned about the long-term economic outlook and will continue to closely monitor forward-looking signals for clues on whether the US can avoid a recession. I would be very, very surprised if they can avoid a recession. The Fed's move to keep liquidity flowing in the sector has partly helped to keep growth afoot. Yes, we've got the answer right there. What is helping to keep things going? It is liquidity. I always talk about this on my monthly macro. I know some of you are not in the private community, but a lot of people are. And I always talk about this principle that we're seeing credit growth as a result, or we're seeing economic growth as well as credit growth as a result of all the new creation. So I guess we can say that economic growth is now driven by credit growth, credit creation. So is it any surprise that when the central bank's creating more currency, that we then see some form of economic growth? No. Is it any surprise when you give people stimulus checks that they go out and spend it, and because consumer spending is a big chunk of the US GDP, that all of a sudden GDP goes up? No, I don't understand why this is a mystery. He says the US is in for a tough time. From our point of view, I can see a bounce for a month or two. It's been quite beaten up. Markets have been coming down since July, but I think net, you want to be underweight equities if you are looking beyond the next few months. I think the US is in for a rough time, he says. So let's have a look here. There's a couple of other things we want to look at. The debt. Let's see if we've got time to look at gold, crypto, S&P, etc. But let's have a look. Actually, do you know what's important? Let's look at this savings rate a moment. So this is from the FRED, the Federal Reserve data, and we can see the personal savings rate. I was watching this economist and I was baffled by the fact that they were talking about, oh, what were these spikes from? And he didn't know. How can you not know what these spikes are from if you're an economist? I was amazed. These were from stimulus and a few other benefits that came through. So we saw the savings rate go up. People put the stimulus into their savings, and then we've seen it plummet. So even if you look prior to, what were we, 7%, 7.5%, but look at it now, it's as low as 2.7%, and as of today, it's still only 3.9%. So the savings rate has gone down. Consumer sentiment as well, prior to everything that happened, look at 2019, it's pretty high, it was around 100. Look at it now, it is 70. So that's a 30% drop down from where it was pre, let's just say a COVID situation. And this is what they were talking about in terms of the S&P as well. You can see that over the last week, it has been going down quite heavily. I don't think that is just as a result of some of the things we're talking about here. I think there's a lot of things contributing to that. Let's see if we can get on to gold in a moment. But this is CNBC then again. US GDP grew at 4.9% annual pace in the third quarter. Better than expected. How could that have possibly happened, you may ask? The sharp increase came to, I've highlighted it for you, contributions from consumer spending, yes, and they're saying this is a good thing. No, we just explain why it's not and where the money actually came from. Another one was government spending huge amounts of money. No, that is called debt. Oh gosh. The US economy grew even faster than expected in the third quarter, buoyed by a strong consumer. No, a weak consumer, this should say. It should say a consumer almost on their last legs. In spite of higher interest rates, ongoing inflation pressures, and a variety of other domestic and global headwinds. Yeah, so they're trying to say then, if you look at this chart here, and here's Q1 of 21, 22, and then 23. They're trying to say, look at this rebound. Wow, we are just on fire. No, look, this was trending downwards. Something has obviously happened to pump this up to 4.9%. It's not as if it even went up by 0.1 or 0.4, 0.5%. No, it went up from 2.1 all the way to 4.9. That is a 2.8% increase. It's over 100% increase in GDP. Obviously, there's something underhand going on there. So it increased 4% for the quarter. GDP investment surged 8.4% as well. And government spending and investment jumped 4.6%. Well, there you go. There's a part of it right away. There's 4.6%. Investors should not be surprised that the consumer was spending in the final months of summer. The real question is if the trend can continue in the coming quarters, and we think not. Correct. That's why I've highlighted that in green. They are correct. It cannot continue. It's the same way if I gave you the example of the flooding. Well, what if I had a glass of water and I'm drinking that glass of water? Oh, let me take a big gulp now, and it's almost empty. Well, it's almost empty. It's not as if there's more water that I'm just going to magically find here. This is the personal savings rate. Yes, people can earn more money, but they're getting so badly squeezed. The other thing is, remember what we talked about with the other article. So I'm linking this together here. We're talking about labor numbers. The jobless claims total 210,000 for the week. That's up 10,000 people from the previous period. And what is driving all of this, again, is due to consumer spending. Look at this in green here. The consumer was responsible for about 68% 68% of GDP in Q3. You compare that to other countries, and let me tell you something. Their GDP doesn't just come from people spending into the economy in the same way the US does. So here's the obvious thing now. If the consumer were to stop spending, what do you think would happen to GDP since they are 68% of it? Drop a comment below. What do you think is going to happen? Going forward, the consumer's not going to spend at the same rate. The government is not going to spend at the same rate, and businesses seem to be slowing down their spending as well. Yes, and their investment and their borrowing, which is another key metric. The personal savings rate declined to 3.8% in the third quarter compared to 5.2%. Again, that is absolutely enormous. Just staggering numbers there. Also, real after-tax income fell 1% in the quarter as well. I thought this was quite funny. The bottom line for the Fed is that no recession is in sight. No, of course not. No, there's no recession in sight whatsoever. We also had the resumption of student loan payments. We've got geopolitical tensions. We've talked about that as well. Let's see what else. Let's look at, before we go on to that, the price of gold now in US dollars per ounce. The month-on-month change is 4.42%, so it's just under 2,000 an ounce. And if we pull a longer chart here, you can see that we did actually get, in fact, let's go to the year chart. We did actually get above $2,000, which is this line here, and that was back in April and May time. So we did get back to about 2,000. I think we're going to get above that again. I can't tell you exactly when that's going to happen, but I think we are going to get above the $2,000 line again on gold, especially with all this instability. So look out for that. And you can see the year-on-year change, 19.5%. Same with crypto as well. Cryptocurrencies, look at the last week. We've had a lot of movement, 18.5% on Bitcoin, 25% on Solana, 42% on Chain. There's been a lot of movement actually with the crypto market. And I just want to wrap up then with this, letting you know about the new US debt clock. This is quite interesting. I know I talk about the debt clock quite a lot, but they've just done some improvements to this, and they've really added a lot in here, and it's worth having a look if you're interested in this sort of thing. And you can see the US debt is 33.6 trillion now, just unbelievable. Even credit card, I was amazed when it hit $1 trillion. It's now 1.3 trillion, over $8,000 per holder of debt. If you've got that debt, you need to get that down ASAP. One other thing I want you to pay attention to is this here, paper to silver ratio and the paper to gold ratio. It is 225 to 1 on silver, 129 to 1 on gold. That is really important that you understand what that means, because some of you are holding paper gold and paper silver, and I just want to warn you against that. You need to be very, very careful about holding this as we go forward. Especially, we talked about the book The Great Taking. We reviewed that last week. You just got to understand there's a lot of risk with some of these things at the moment. I like to have physical, as you know, I like, especially my assets at the moment. I've moved very heavily from digital or equities-based assets. I've moved quite heavily into tangible assets at the moment. So that's more of a certain type of property or real estate, not your sort of mainstream stuff, because I think this is really going to suffer. I'm not in office blocks and things like that, but I have, because it'll take too long to explain. It's all in the private community. If you're in there, you can read all the posts and what I've been doing and investing in lately. But that's the way I'm doing it at the moment. I think there's just too much risk. There's too much instability. I want to be able to touch and be able to be in very close proximity to assets as we go into this crisis. It doesn't mean I'm not going to have equities and stock market and things like that, because I will. There's always opportunities. There's some things that are extremely undervalued right now. So even if we went into a crash, would it make me regret buying them? No, it wouldn't, because some of them are paying good dividends. Some of them are already massively undervalued. They've got a lot of growth when we come out of however deep this next recession is going to be. So there's still a lot of opportunities, a lot of investment opportunity out there. But I think I'll wrap up there. Thanks so much for being online. I really appreciate it as always, and for you being a subscriber here. Take care. God bless you guys. And other than that, I'll see you tomorrow. Hopefully, we can do the walk and talk if the weather holds out. All right, see you then.